My style and approach certainly do well when the markets are underperforming and markets are doing poorly. That plays to my strengths. I think concentration plays to Roshi's strength. Gopal's fund, which tend to be a little bit more diversified, that plays to Gopal's strength. So Rahul certainly has a better appreciation of quality, a better appreciation of growth, certainly than me.
I understand the more I do this Know Your Fund Manager series with different active fund managers, I've been realizing how difficult and how nuanced one has to go to understand each fund manager and their style and their execution, etc. You being an active fund manager, if you were asked to pick another active fund manager to invest your funds, how do you go about it, Chirag?
I'm shocked, not surprised, by how little people know about their funds. Everybody knows performance, but performance will be driven by stock selection. Performance will be driven by sector allocation. Performance will be driven by style, are you growth, value, etc., and is the market appreciating it? Performance will be driven by luck, and then performance is partly driven by size.
Hi, I'm Satya Sontanam from Zerodha Varsity. Welcome to the 8th episode of Know Your Fund Manager series. You know, in this series, we deep dive into the styles of fund managers and tell you what to expect when you're investing in their funds. In this episode, I have with me Mr. Chirag Setalvad, the Chief Investment Officer of HDFC Mutual Fund. HDFC Mutual Fund is one of the top fund houses in India in terms of how much money is being managed. With that kind of money, they don't want to restrict themselves to one style of investing. So they now have different styles of investing like growth, value, GAP, growth at reasonable valuations with which they run different funds. So in this episode, I asked Chirag on how some of the HDFC flagship schemes like HDFC Balanced Advantage Fund, HDFC Mid-cap Opportunities Fund, Small Cap Fund, Focused, Flexi, Large and Mid-cap funds, etc. are managed. He shared not just his investing style, but also the investing style of other senior fund managers like Mr. Gopal Agarwal, Ms. Prashant Jain, Rahul Baijal. Chirag doesn't like taking the whole credit, so you'd see him talking about his team a lot. Also, being an active fund manager, he also shares some knowledge on how to pick an active fund manager. I hope you find this conversation insightful as I do. Chirag, thank you so much for joining us today. Welcome to Know Your Fund Manager episode, and we are really pleased to have you here.
Thank you for having me on board.
Chirag, I've been following mutual funds for some time, and when Mr. Prashant Jain left HDFC Mutual Fund, it was a big moment. And there was also an apprehension on what happens to the performance of the mutual funds. And I was writing a story back then, and I also talked to a lot of people in the industry, from distributors to registered investment advisors, a lot of people. And if there is one thing that is common across all these advisors or the experts to say, is that there is no lack of skill in HDFC Mutual Fund at that point in time. There are very senior fund managers like you, Mr. Gopal Agarwal, Roshi Jain, etc. And it will be taken care of. And there is no apprehension, at least in the distributors and the REA's perspective. Now, I think this question is asked a lot to you on how is it to fill such big shoes of Mr. Prashant Jain. I know how the transition has been. It's been smooth, so I'm not getting into that question. But tell us, how is it going, Chirag, as the CIO, from the fund manager to the Chief Investment Officer of HDFC Mutual Fund, which is, the second largest AMC in India, managing a lot of public money. How does it feel like?
So, like you said, the transition has been a smooth one. I think I've been fortunate that I inherited an organization and a setup which was running extremely well. And, very often we focus on the individual, but the organization is far more important. The CIO gets attention, the fund manager gets attention, the analysts don't get attention. And the analysts are the bedrock of what we do, right? We are research-driven organizations, and we have a team of 11 individuals. They're extremely talented. And it is through their hard work and effort and on their shoulders we stand. And I think that is incredibly important. And we've seen a lot of continuity on that front. And we have an incredibly talented team. And as an organization, we have very strong systems and processes and philosophy. So very often the individual gets attention, but the people who really matter don't get enough of attention. So I think the organization was very strong. The philosophy, thought process, the research that we conduct, I think all of that is extremely robust. And hence, it was, in that sense, of course, Prashant's loss is a big one because he was a great mentor and great person to work with. But the organization is far larger than the individual. So many organizations in India as well as globally have seen luminary investors leave, and yet the organization as a whole continues, right? And not just in investments, but even in sort of the corporate world, right? You feel that the individual becomes, takes so much of the limelight that you feel that how will the organization move ahead without the individual. But we are large organizations in that sense, and we have a very competent and capable research team, and it is because of them that we do well. So in that sense, the transition has been an easy one, whether it's when Prashant left or when I leave. I'm sure nothing will change, and the organization will hopefully go from strength to strength.
Got it. When Mr. Prashant Jain was heading as CIO of the fund house, it was largely seen as a value-driven fund house. Now, in the last few years, with multiple discussions that you also had with the media or even the CEO, it's understood that it's more of a diverse style fund house, not just restricted to value. I want to get into how each fund is being managed in what respect in terms of style. But before that, Chirag, is there any one particular philosophy that the whole HDFC Mutual Fund funds are based on?
Sure, let me answer that a little bit differently. I think first to start with, the definition of value itself is not static. It changes over a period of time. There have been sectors which occupied value and now occupied growth, right? And that could be financial services, it could be pharma. Pharma was a value sector at one point, then it's become a growth sector. IT as well, growth to value to growth. So the definition of value itself changes significantly over a period of time. So I think that's important to keep in mind.
So when you say value, is it based on the PE multiple or the PB multiple?
See, I think it is where is emphasis, right? When we look at a business, we're certainly looking at valuations, we're looking at growth, we're looking at management, we're looking at competition. So you're looking at the whole gamut of things. I think the value investor, the emphasis is a little bit more in terms of the price that you pay. And for a growth investor, the emphasis is a little bit more in terms of the future outlook and the growth that is embedded in the business. But there is elements of both in pretty much every investor. There is nobody who's going to say, I only care about growth and I don't care about anything else, or I only care about the price that I pay and I don't care about anything else. So I think it's easy to slot into value and into growth, but the reality is, it's shades of gray. It just depends on which part of gray you are focusing on a little bit more. But I think in general, it is fair to say that most investors in India are GARP type investors, right? So there's growth at a reasonable price. Some are focusing more on the G part of it, some are focusing more on the price part of it. Our philosophy has always been fairly straightforward, right? So we have always been largely a bottom-up driven organization, the way in which we create our portfolios. We are very research driven.
Bottom up means like looking at the fundamentals first.
So very fundamentally oriented. We have an extremely rigorous research process. We have a laundry list of requirements which we need to adhere to for every company that we own and that we cover, in terms of how often we meet them, how often we write, how often we the kind of documentation we have. So it's very, very rigorous from a research standpoint. So as a result, it's a very bottom-up process in the way in which we create our portfolios. Now again, bottom-up doesn't mean that we don't look top-down. Of course, we look from a sector standpoint, we look from a macro standpoint, but it's about emphasis. Is the emphasis more from top to bottom, or is it from bottom to top? So I think for us, we're very fundamental in nature, we're very research oriented, and we're much more bottom up in our orientation. So I think that's a key part of our philosophy, that over a period of time, stocks will reflect intrinsic value. So that's, the key tenet of what we think about. The second is we are, I think, very long-term in our orientation. I think we are also a little bit contrarian in the way in which we do things. We are not starkly contrarian, but we are very excited to look at things which are ignored, whether it is sectors which are ignored or stocks which are ignored. I think that is something which certainly drives us. So that's the third part of our philosophy. And the fourth is, very often in this business, we focus on the big winners, right? You want to get multi-baggers, 2x, 10x, 5x, whatever. But this is as much a business about focusing on minimizing losses, right? As my first boss told me, to finish a race first you need to finish, right? So it's very important to, as a result, to minimize the minus 50, minus 80, minus 100%, those losses. So it's a combination of bottom-up, research-driven, long-term orientation, stick within your circle of competence, try and minimize your mistakes, and be a little bit contrarian. We're not, I think, dramatically contrarian, but I think all of these things, when you put it together, we do have a value tilt. But I think that has changed. As you said, when Prashant was there, there were possibly two managers who were responsible for most of the assets under management. And post his departure, his funds have been distributed between Roshi and Gopal and Rahul and Srinivas. And hence there is a lot more diversity, because while there is a common philosophy, each individual will certainly bring his or her perspective, worldview and so on to their portfolios. So now that you have many more managers managing this corpus, there is certainly a much more of diversity. And it's important to quantify that. So when you look at overlap, so three of our flagship schemes, Balance Fund, Top 100 and FlexiCap, the overlap between these products were much higher if you go back 5 years ago. They had anywhere from a 70 to 80% overlap.
Common stocks between them.
That overlap has come down sharply as each manager brings to bear his perspective. So automatically there is a lot more diversity. And I think that results in a more balanced investor experience, a little bit less volatility. And I think overall that has worked well. And we have done this very consciously to give portfolios to managers with different perspectives and bents of mind.
Why is it so?
So that we don't sink together and swim together, right? You don't want everybody doing well at the same time and everybody doing badly at the same time, right? You want to have that diversity in performance. It's good from a business standpoint. It's good from an investor experience standpoint. If you invest in poor HDFC funds, you don't want to have terrible performance and fantastic performance and sleep well and sleep badly. You want to ideally have a more mixed, balanced experience. And I think that's what we endeavor to do. We had that opportunity at a couple of years ago when Prashant left to do it, and I think we've demonstrated that in the last few years.
That emphasizes the point that all styles doesn't do well in all the market cycles, and each style has its own up cycle, and each style has its own down cycle. So if we have to talk about some of the flagship schemes in HDFC, now you're saying different fund manager are bringing in their own different styles. Earlier, as you said, most of the HDFC funds were looked at as value funds. Now it will be like more of a growth, some GAP, some value. I want to understand, at least for some of the flagship funds. The first is, of course, HDFC BAF, which is one of the highest AUM funds in HDFC, Balanced Advantage Fund. How does the style of that particular fund has changed? As per our understanding from the public point of view, from what we have read, earlier it used to be more equity heavy. Now slowly that equity has been coming down. The equity exposure has been coming down. Earlier there was no hedging part. Now there is more of a hedging part that's coming into picture. Like that, what are some of the features that has changed for BAF? And what is the style when it comes to equity stock allocation?
Sure. So we start the answer by saying that there is a common philosophy which goes across all managers and as an organization. But obviously within that, each manager has his or her own emphasis. For a long period of time, we ran a fairly static allocation. So we were between sort of 70 and 75% on a fairly consistent basis across market cycles. And that higher allocation to equity worked because India is a growth market. So markets will always, over a period of time, hit new highs, and that worked. When it got shifted to the aggressive category, to the dynamic category, we needed a different approach because that was the nature of the category and the product.
Could you explain why you've changed to dynamic? What is dynamic and why you've changed to dynamic?
So we had two hybrid products. We had HDFC Balanced or Prudence at that time, and we had HDFC Balance Fund. So one went into the aggressive hybrid category and one went into the dynamic allocation category. And now that you're dynamic, you need to be dynamic, right? You can't hold on to a 75% allocation regardless of the market cycle. So now we have an asset allocation committee which determines what our allocation should be to equities. And that is partly a function of valuations and a variety of valuation parameters. There'll be PE, there'll be earnings yield to bond yield, and so on, so market cap to GDP, etc. So that's one aspect to it. Then on that we overlay, of course, our macro view in terms of GDP growth and things of that sort. We also put in parameters like liquidity and breadth of market performance. So a variety of things go into deciding what allocation should be. And there is a range.
Is it automatically determined based on the model?
So the model throws out a range, right? So let's say the model throws out 50 to 55 and the fund manager has a little bit of flexibility around the range, but you certainly have to move to that range. Otherwise it's pointless. It's no use having a methodology and then not following it. So in that sense, we are much more dynamic. So from running a 75% equity product for a extended period of time, between 75 and 80 to be more accurate, it's much more dynamic now. So we are now closer to 50 based on what our model throws out. So it's much more dynamic than what it used to be.
HDFC BAF, if I'm not wrong, has given in teens, a higher teens, performance in the last, since its inception, which is more than 18-20 years. It has given tremendous performance, and it's been one of the best performers in the category. And do you say that's also because it has the higher equity exposure? And can we expect similar kind of performance? Now, most of the investors who invest in funds look at the past track record and invest in them. And they must be looking at this BAF and then saying that it has given like tremendous returns, and they must be expecting the same returns going ahead also. But now the style has been slightly changed, which is now more dynamic. So what can they expect?
Well, it depends, right? In a sense, the outcome will be more or less similar, because earlier the approach was to follow a, let's say, 70% allocation or 70-75% on a consistent basis. Now it's a little bit more volatile, right? That depending on how the market behaves, will be at some points will be 50-55, other points will be 75-80.
Yeah.
But it'll still average out to a similar sort of number. So it's not that the equity allocation is changing dramatically, because at the end of the day, equity returns are far different from fixed income returns. Now maybe from a 75, it will be closer to 70, but I don't think that 5% makes such a dramatic difference. So no, I don't think return expectations from this product should change over a period of time. I think you should still expect, a weighted average of equity being 70% weightage and fixed income being the balance. It's just going to be a little bit more dynamic. In fact, one can argue that possibly if the model works, then you can actually enhance returns, right? Because you are investing less when markets are expensive, and you're investing more when times are more challenging and valuations are more attractive. So hopefully you're adding, the asset allocation adds a little bit of value to the portfolio. So that can possibly make up for that 5% lower allocation over a period of time. So I don't think the returns will change.
Okay. So if I have to go back and go back to your calculation where you're saying 70% will be equity, and the remaining 30% will be fixed income returns. So 70% equity, if we say 12% into 70, like it's about 8.4 or so. Of course, I'm not getting into too many details, but then ballpark number, and then the fixed income could be around 3% or so. So can we, is that the expectation one has to keep in mind, rather than thinking that, okay, I'll also get that high teen, returns from this fund, so just like before?
A few nuances to that, right?
Yeah.
First, I'm not sure, but most investors would not be happy with a 12% overall equity return. Right now, you assume that economy is growing 7-8% in real terms and 4-5% in terms of inflation. So your economy is growing at, 11-12%. And that includes agri. You remove the agri bit out, and because agri is not represented in the stock market so much, then actually growth is a little bit higher. So that's, first of all, overall market returns, right? And then when you look at the mid cap, small cap, typically you would expect a higher return from that. So you add a little bit more to that number, right? So you started off with a 12, and you've now gone a little bit higher because you added a little bit of mid cap, small cap flavor to it. So that pushes up your return, and then of course you have alpha over and above that, right? So we don't want to just give market returns, otherwise, what are we doing from a value add perspective? So then you hopefully have a couple of % to alpha. So now you've moved from that 12 to maybe 14, 15, 16, depending on what your starting off point is and what your ending point is.
Makes sense.
So now you have to bump up your returns as a result of it. And then, of course, the asset allocation bit itself will also hopefully add a little bit of value. So it's not just 70% gives X return and 30% gives Y return. It's also the change of the mix, which will also add to your return.
Because you are selling at the highest level and then buying at the...
Ideally, you would like to be doing that. I mean, that's the intention at least. So I still think you can get away with, I mean, you're not going to get equity returns because it's not a pure equity product. So if equity gives you closer to sort of 14-15%, then a little bit lower than that. But actually, we've seen very strong returns in BAF, almost comparable to pure equity funds.
True. It's because of the asset allocation?
That certainly helps, yeah.
Got it. Now, we're talking about Mr. Gopal, who is now the fund manager on the equity side, along with Mr. Srinivasan. So could you also give some gist about what their style for the fund is like? Because earlier it was run by Mr. Prashant Jain. Again, it's more of value focused. Now, what is the style like on the broader level?
So I think Gopal is fairly eclectic as a manager. Some of us get slotted into growth and value a little bit more. I think he straddles a lot of it. And I think, it's a great testimony to his capabilities that he is able to dip into growth, he's able to dip into value. And that creates a portfolio which is much more sort of varied than you would find for a lot of other managers. So I think that's, I can't categorize him into purely growth or purely value. I think he manages to do both, and not everybody can do that. So I think it's a mixed, it's a balanced approach between, he has enough of growth stocks, he has enough of value stocks as well. So I think that's one part. I think he also likes to run fairly diversified portfolios, and you can see that in the number of stocks that he runs. So I think that's helps reduce risk. It also adds and creates a portfolio which is a little bit more diverse in that sense. So I think he's fairly eclectic, and he is, he likes to run diversified portfolios.
No, so the same goes for the HDFC large cap and multi-cap as well?
That's broadly true as well.
Got it.
Well, large cap is not large and mid, but because large cap is run by somebody else.
Yeah. So for large and mid cap and multi-cap, it's the same kind of style.
It's a similar style. Yes.
Similar style. Got it. Now, when it comes to the multi-cap, there is this 50, 25, 25. Do you also want to talk about how this category is like? I mean, do you like this category? 50, 25, 25?
I mean, there is, I think you have to have products which cater to different investor requirements, right? And I think the 50, 25, 25 forces you by definition to put money into those categories. And it takes away the discretion of the fund manager. So it brings a certain amount of discipline that you have to have 50% in large cap, you have to have 25% mid, you have to have 25% small. So on one hand, there are, I think, advantages and disadvantages. The advantage, of course, is that it brings that discipline that you have to have allocation. The disadvantage is that you then have to do it even in times when you don't want to. Yeah. Right? Even when markets are, for argument's sake, small caps are, and I'm not saying this is the case, but if small caps were to be ridiculously expensive, bizarrely expensive, you still have to put 25% in there. So then that becomes a disadvantage, right? But imagine if small caps are ridiculously cheap, but they are out of flavor, and hence there could be a temptation not to have it in your portfolio. Oh, I don't like this, it's not working, there's no momentum in small caps. Small caps have gone through phases when small caps and mid caps were, now of course they're flavor of the season. There have been points of time when mid cap and small cap was considered to be, touch me not. There's nothing happening in this segment. These are risky, dangerous, corporate governance risk type stocks. So then there would be a temptation to stay away from those stocks. But if the product forces you to put money in, so it's interesting. Sometimes the product will force you to put money into a category at the bottom, and sometimes it'll force you to remain invested at the top. Exactly, so there are pluses and minuses.
Yeah. Because it could also remove your biases and then, force you to invest in that.
Yeah.
Got it. It's like a sip.
Yeah.
Got it. Now moving to your funds, Chirag, you're also maintaining some of the flagship schemes which are like HDFC Mid-cap and HDFC Small-cap. HDFC Mid-cap you've been running since 2007 and Small-cap since 2012, if I'm not wrong. Yeah. And HDFC Mid-cap is also one of the, big funds, second actively managed fund. Let me come to the size which many people ask you. But before that, Chirag, who were your investing gurus or who did you learn investing from?
I've had two big influences in my life, which is not a surprise because I had two bosses who who played a pivotal role. So Sanjoy Bhattacharya was the first CIO at HDFC, and he played a massive role in my learning and development, and I attribute a lot of what I have learned to him. So he gets blamed and he gets credit for failures and successes both, to some extent. But I was very young when I joined the industry, and hence I was, it was easy to mold. I was easy to mold, and it was a blank canvas. So to have somebody like Sanjoy, who was so incredibly knowledgeable and passionate, it really had a tremendous impact. He encouraged me to read a lot. He helped me analyze balance sheets, threadbare, and he was an incredible teacher and mentor. So I learned a phenomenal amount from him. And in those days, we'd go for road shows. I mean, not road shows, but company visits. And it was Sanjoy, Ramdev, and myself. Okay. And you can imagine, I mean, how much are you going to learn if you're traveling with these two guys, right? And they would meet companies, and they were so incredibly passionate, and they covered the company from A to Z. And I was a young man learning a hell of a lot from these two incredible individuals. So Sanjoy played a massive influence in my learning and growth. And then post Sanjoy's departure, Prashant took over, and we all know what an incredible investor he is. And it taught me a lot in terms of the merit of hard work, how to manage risk, portfolio creation. He's the consummate institutional investor. And we've all learned an incredible amount from him. We've all become better investors as a result of working under him. So not just me, but all the other managers, all the analysts. I mean, you come into HDFC hopefully reasonably strong, and you leave HDFC much stronger because you have people like Prashant to learn and grow with. So that's why I keep saying, if you work with such incredible individuals like Sanjoy and Prashant, how can you not be a decent investor yourself? So I would attribute a lot to both of them.
So if you have to talk about your style, Chirag, how do you place yourself, growth, value, gap?
So I'm a little bit more value oriented, certainly. I think the price that we pay for a business is very important to me. But that has also changed over a period of time. I think I have realized that not to get overly carried away with valuations, and it is okay to pay up for those businesses which can deliver and can compound over a period of time. Superior businesses, superior managements. You don't always get them cheap, right? And you may have to overpay compared to what you're comfortable with. But when you do pay that little bit more, what you get in return is sometimes far greater. And that is the value of compounding, right? That when a management or a company can deliver 3 to 4% extra over a period of time, that 3 to 4% over a 10-year, 15, 20-year period is, a massive outperformance, right? So why are we getting carried away? Why the 10% or the 15% starting off? Because that 3% over a 15-year period will be far greater than what you are sort of sacrificing from a valuation standpoint. So I think there has been a learning. I think I was, in the earlier part of my career, possibly a little bit more value. I'm still, I would say, value oriented, but I think it was the emphasis was a little bit more on value, and it has now changed a little bit. And recognizing that paying up for businesses which are far superior and for managements which are far better executors can be a very, very rewarding experience. Right? And it's a little Buffettian, right? Buffett also had that journey, right? With Benjamin Graham as his key influencer, was very value oriented at the beginning, and then has changed quite a bit over the last sort of 25,
because of the influence
30 years.
Of Charlie Munger.
Because of the influence of Charlie Munger before his own life experiences and so on. So I think that is true for some value investors, certainly, and I would put myself in that category. That yes, the price that you pay is still important. It gives you a margin of safety, which is something that I sort of grown up in investing, thinking about. But it's increasingly there is an element of other aspects in terms of quality executors and quality businesses and so on, and therefore okay to pay up. And we've had great gainers where we've paid, where the starting of valuation was a little bit more than we were comfortable with. But you don't want to pay a hell of a lot more. So I think that's the balance, that don't only focus on valuation, certainly not. It's okay to pay up. It's okay to pay up a little bit extra. Is it okay to pay up a hell of a lot more for a business which can arguably deliver sort of fantastic growth. And that bit I'm uncomfortable with, because I'm fundamentally a believer in mean reversion. I'm fundamentally a believer in competition. So I don't think companies can grow at a ridiculous pace for an extended period of time, because enough of people will come in. We're a highly competitive economy and culture. So it's a value, but it's shifted a bit.
Got it. Now the same philosophy continues in the HDFC small cap fund as well.
Sure. Yeah. So the philosophy in mid cap and small cap is the same. It's just the segments which are different. One is mid cap, one is small cap.
When we look at the performance, Chirag, for mid cap, it has been a more of a consistent performance. Even when some of the big funds, flagship funds of HDFC fund, mutual fund, are not so in the limelight during some period from 2015 to 20, mid cap has been a consistent performer. But the same is not reflected in small cap. Why is that so?
See, the categories are different, right? The mid-cap definition is 150 companies. So in that sense, it's a much more limited universe. And hence, the variety of returns in 150 companies is going to be much more limited as opposed to 2,000 companies. Because in 2,000 companies, you're going to have 10 baggers and minus 50% returners as well. So the volatility of returns in small cap as a category is far higher. And hence, the volatility of returns in funds will also be higher. And I think that's what has happened in small cap. We've seen more volatility in performance. Over a period of time, the fund has done well. But because the category is more volatile, we're going to have more volatile performance.
No, if I have to take the liberty and go ahead and ask this question, I'm also comparing the category performance, like when comparing against the category. When it comes to HDFC mid-cap, it has been more consistent in the top quartile, but it's not the same with small cap. So what are some of the, are there any misses in the way it was run in the HDFC small cap fund over the years? And is there any learning over there?
No, I don't think there is. I don't think there is anything I would particularly point out. But I think what happens is, so when you think of our performance, we typically, the small cap fund in particular, typically will, or broadly, my style and approach, I typically do well when the markets are. Certainly do well when the markets are underperforming and markets are doing poorly. That plays to my strengths. When the market is behaving normally, which is sort of 15-20% plus minus, then we tend to outperform maybe 50, 60, 70% of the times. And when the market is on a tear and doing fantastically, we tend to outperform much more, because we don't own the kind of higher risk companies and we don't have that kind of beta in the portfolio. So I think what's happened in the last couple of years, obviously we've seen a fantastic run in mid cap and small cap, and being somebody who's a little bit more conservative, we've had as a result in small cap in particular a performance which has been more volatile versus the category, but I would attribute it to that largely.
I understand. That puts a lot into perspective.
So what happens is you're comparing it at a point of time when the market has done very well, which is typically not playing into my strength. And it's more true in small cap because, like I said, mid cap is a confined universe and small cap is a large universe. So I think you have to look over a balanced period of time. So don't look at a bull market, certainly, because if you look at a bull market, then the performance will look a little bit more challenging. You look at a bear market, it'll look much better. So you got to look across the cycle. And I think across the cycle, it'll be volatile, but we certainly would like to have, it'll be more volatile performance than mid-cap for sure, but point to point over an extended period, we have done reasonably well.
Got it. That makes a lot of sense. And when it comes to small cap, has it been the small cap fund all the time long, or
no? So this was Morgan Stanley ACE.
Yeah.
So you've got to look at performance for the last sort of 7-8 years since we acquired. When we acquired Morgan Stanley ACE, when we acquired Morgan Stanley Asset Management, the ACE fund was rechristened as the small cap fund.
That was also into small cap earlier?
No, that was a multi-cap product.
Multi-cap product.
So you can't go back. The history of the fund is possibly longer than when it was a small cap fund.
But we can't compare directly to the small cap?
No.
Got it.
So that's the other reason.
Now, moving on, the other, one of the senior fund managers in the fund house is Miss Prashant Jain. There are a couple of funds that she's managing, which is Focused, ELSS, Tax Saver Fund, and also a Flexi Cap Fund. Why don't you talk about her style and how it reflects in these funds?
Sure. So I'm incredibly fortunate to work with Roshi. I think she's a remarkable individual and a genuinely very smart investor. Very clear in her thinking. She likes to take a strong bets, and you can see that. I think one key part that you observe in our portfolios is they tend to be a little bit more concentrated versus what you see, for example, in Gopal's fund, which tend to be a little bit more diversified. That plays to Gopal's strength. I think concentration plays to Roshi's strength.
Because she's coming from Franklin, where she ran a focused fund for a long time.
These things depend on how you have. It's been your experience in the industry. So I've had a mid-diversified strategy since day one, and it's worked for me. So I don't want to change it. Roshi's had a concentrated style that's worked for her. So why change it? And Gopal's had a diversified style. It's worked. Why change it? So it depends on how you've been introduced to the industry, how it's the experience that you've had. So I think Roshi's a little bit more concentrated in her approach. She also has a value orientation, which is visible in her portfolio. So I think those two things make her stand out. But I think she's a very clear thinker. I think she's also a little bit more strategic in the way in which she thinks about things. She certainly looks bottom up, but also has a top-down perspective.
Got it. Can we also talk about the other fund manager, Mr. Rahul Baijal, who's actually also leading one of the flagship schemes, which is HDFC Top 100, which is now the HDFC Large Cap Fund?
So Rahul has a different approach. He's a little bit more, I would say, growth oriented in his mindset, and that's something that we're delighted to have as part of our team, because we want, like I said earlier, we want a diversity of styles. So Rahul certainly has a better appreciation of quality, a better appreciation of growth, certainly than me, and you can see that play out in the large cap portfolio which he runs. And so his style in that sense, he's I would say mid, if Roshi's a little bit more concentrated, Gopal's a little bit more diversified. I think Rahul's somewhere in the middle, and he's a little bit more quality focused and growth focused.
Understand. Since this is just mostly targeted towards equity investors, we are just leaving it to only the equity fund managers. Is there any other fund manager that you would like to point out to regarding the style?
I would love to point out each one of our research team, right? So you guys don't hear about Anand Ladda, who's our banking analyst. You don't hear about Nikhil Mathur, who's our pharma analyst. You don't know about Rakesh Setia, who's our oil and gas analyst. Abhishek Podar, who's our capital goods analyst, or Bala, who's our IT analyst, and I've not mentioned each one, but these guys are our strength, right? When we focus way too much attention, I think, on the fund house and the fund manager and the CIO, and Amit Sinha, who's our FMCG analyst. I mean, Dhruv, who's our power analyst. I mean, these are the bedrock of what we do. So rather than focus on managers, I think I would love to spend more time talking about each of these individuals. And these are the guys who provide us the ideas. These are the guys who are hitting the road and kicking the tires and analyzing companies and coming back, and they have to bear the brunt of our discussions and arguments and whims and moods and all of it. And they are the key part of our business, and they go unnoticed. They go unnoticed at HDFC. They go unnoticed at all other asset management companies. Or why is this a one-on-one interview? This should be a 1-on-14 interview, right? Because these are the 14 people or 15 people who really contribute. So I think we really underemphasize it, and I think it's unfortunate, because they are the strength and the bedrock, and I'm immensely grateful. I think my performance would have been far, 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 far worse had it not been for each of these people. They've each contributed dramatically to all our performances. And this is the strength of our company. And so I don't think I mentioned everybody, and that's not good for me, but
I'm sure that everybody would appreciate it. Yeah. Got it. So if there is one thing, Chirag, if you, as the CIO, Chief Investment Officer, if there is one thing, what is it that you want investors to expect in terms of performance from HDFC funds?
I think all investors want the same thing, right? Risk-adjusted performances which are superior. So I think very often investors only look at performance, and they don't look at the risk part of it, right? Making a 20% return in Hindustan Lever is not the same as making a 20% in a SME, right? You'll have different expectations in different categories. So I think risk, I would like to think that investors should look at risk-adjusted returns. What is the kind of risk portfolios are taking?
How do they see it?
You have to look at volatility. You have to look at the nature of companies. So it's not that easy. There is no one single number. Is beta enough? No. Is volatility enough? No. So there's no one particular number. I think you have to look at ROEs, ROCs. So these are high quality portfolios or not? But I think on a risk, we would hope that not just for us, but for every fund house, that investors should look at risk-adjusted returns, because there are funds which are more aggressive and there are funds which are more conservative, right? The fund houses which are more aggressive and those which are more conservative. Do you use the same yardstick to judge everybody? I suspect not.
I understand. The more I do this Know Your Fund Manager series with different active fund managers, I've been realizing how difficult and how nuanced one has to go to understand each fund manager and their style and their execution, etc. You being an active fund manager, if you were asked to pick another active fund manager to invest your funds, how do you go about it, Chirag? Do you think it's a difficult job?
I think it is a difficult job, but not as difficult as people make it out to be. Let me put it this way. I think people I'm shocked, not surprised, but I'm shocked by how little people know about their funds, right? So everybody knows performance, right? That's a given. You certainly know the last 1 year performance. Chances are very focused on 3 months, 6 months, 1 year.
You mean the investor?
The investor. But beyond that, what is the knowledge of the investor, right? When you buy a phone or you buy a television or you buy a refrigerator, we do hajar research, right? We'll go online, we'll read reviews, we'll compare products, we'll speak to friends and so on and so forth. For a 50,000 or a 20,000 rupee purchase. For a lakh and crore rupee purchase, what is the kind of research that we are doing? Do you know the PE of the fund? Historical 1 year forward, 2 year forward? Do you know the return on equity of the fund? Do you know the return on capital employed of the fund? Do you know the debt equity of the fund? So some of these things, beyond a point, you can't do this, right? Because you've got a day job and investing is something that is meant to be not a full-time activity. But I do think investors should spend a lot more time looking at portfolio statistics. What is the churn of the portfolio? You ask a typical investor, what is the PE of his fund compared to the category, industry, stock market? Nobody knows. Right? Is it a high quality? Everybody says high quality, but what is the return on equity of that portfolio? Which demonstrates quality to some extent.
Where to see these numbers? The ROE, ROC, or the PE that you say?
Everybody has. Most guys are investing. No, the fact sheet will not give this because we're not mandated to disclose this level of information. Everybody has a distributor or advisor. Right? What are we asking our advisors? Are we asking our advisors difficult questions? Or these are not even difficult questions, these are easy questions. I want to know for each of my products, what is the PE, ROE, ROC, dividend yield, churn, concentration, top 10, bottom 10. So how overly diversified, overly concentrated it is, sector, XYZ, manager, tenure, etc. 90% of these questions are not asked and hence not answered. Advisors don't know the answer to it, right? So, how are you going to compare two different products? What is the growth, embedded growth? Now, some of these numbers can be a little bit difficult, especially if they're forward-looking. Historical numbers are available to all. Yeah. But now what is the earnings forecast for the last 2 years for the portfolio, for the next 2 years for a particular portfolio may not be known because you don't have Bloomberg and you don't have those tools available. But I think investors have to ask a lot more questions, right? I think that is a basic responsibility that we have. What is the liquidity of the portfolio? How many people know how illiquid their portfolios are? So I think a lot of these questions are not answered, and it is up to the person who is buying the product to ask the advisor, and who is then bound to answer these questions.
That's a very interesting question, Chirag. If I have to understand what's the ROE and the ROCE of the portfolio, how do I go about understanding this?
So the ROE of the portfolio is the weighted average of
ROE of the companies
in the portfolio, and that kind of stuff is all. Historical is available, right? So I may not have it for 25 and 26 because those are forecasts, but I can have it from 24 going back for the last 15 years. Compare that to a competing fund. We do rigorous analysis on companies. That a fair amount of that rigorous analysis can be done for mutual funds. But who's doing it? Right? Who's disclosing these numbers? Has the portfolio churn changed over a period of time? Has this always been a 15% churn portfolio? Right? So you have to look at it static and you have to look at a time series. And are we really doing that? And we're investing lakhs and crores of rupees based on reputation, based on imagery, based on performance. And some of that is important, and philosophy, which is all very important. But we also have to see, because the proof of the pudding is in the eating. right? This portfolio has to stack up. So, like I said, everybody has the broad same philosophy: invest in good quality companies and hold for the long term. But is it getting demonstrated in the actual portfolio?
Right. I'm going to use that because when you said we're going to spend a lot of time, seeing what kind of phone is good for us, for the 50,000 purchase or 60,000 purchase. But through SIPs or through lump sums, we are investing a lot of amount every year, and we don't actually ask right questions in what mutual
I think
funds.
retail investors don't ask that question when buying stocks. You will buy stocks based on what your neighbor tells you or your friend tells you or what have you, right?
Yeah.
And then you're investing meaningful amount of money in that or for mutual funds. So I think, it is incumbent on the investor to ask questions. Nobody's going to reach out to you and give you the information. You have to seek it. And when you seek it and when you have that information, you all of a sudden have an advantage because you have an analysis which other people have not done. So I don't think that detailed analysis is being done.
Got it. It is more important because if you see any category, the actively managed funds, the worst and the best performer, there is a huge difference in the return that these funds have been giving. I'm not talking about in the short term, but even in the long run, there's a huge difference. And asking these right questions will make a difference.
So I'll give you the example of the mid-cap fund, for example. Our philosophy, so we want to buy good quality companies. And that has been demonstrated by us by a return on equity of our portfolio has been consistently higher than the benchmark over a period of time. We want to buy them at reasonable prices. Our P multiples have been significantly or materially lower than the benchmark for an extended period of time. So you have to look at ROE time series, you look at PE time series. But what we have done is we've compromised in terms of liquidity to some extent. Now we can manage the liquidity pyramid through large cap, mid cap, small cap, cash, all of that stuff, portfolio management. But there is a illiquidity which comes along with some of these things. So I think, that kind of analysis is not being done as much. And then you look at portfolio turnover. So when we say we invest in good quality companies for the long term and hold it for an extended period of time, you have to judge it through ROEs, you have to judge it through PEs, you have to judge it through churn ratios. You can't judge it based on what I'm saying. There has to be tangible, it has to be demonstrable.
Got it. And since you talked about the liquidity also, maybe quickly, Chirag, because the funds that you are managing are also, high AUM funds. Yep. And most people actually, this is the first question I'm sure that you would get most often, that the size of the fund is too big and the opportunities that you may find in mid cap and the small cap could be lower. How do you deal with that size?
Sure. So, my answer has been the same for eons, right? Performance is driven by a variety of factors, right? Size is one of those factors, and we can sort of drill down to size in particular. But performance will be driven by stock selection. Performance will be driven by sector allocation. Performance will be driven by style, are you growth, value, etc., and is the market appreciating it? Performance will be driven by luck, and then performance is partly driven by size. So there are 5 things, right? So it's a fist. You put the 5 together and you create that fist. You can't poke with one finger, right? Okay. Now within size, you can have a large fund which is not necessarily behaving large. You can have a small fund which is behaving large. So I'll give you an example. Our mid-cap fund is the largest by AUM in the category. Right. And we are 2x, 3x, whatever of the number 2 fund. And actually that gap has narrowed. Earlier we were 5x, then I was 2.5 times 3x. But our weighted average market cap is amongst the lowest in the industry. So if you took our portfolio, if you took the HDFC Mid-cap Opportunities Fund and you hit the name, could we really guess what the AUM is? Because it's not that we own larger companies. It's not that we own sort of a lot more large caps, a lot more large mid caps. In fact, we own more mid caps and small caps compared to portfolios which are smaller than us. So a 75,000 crore mid-cap AUM is owning smaller companies compared to our 15,000 or 5,000 crore competing product. So which is large and which is small? So I would argue, yes, we are large in an AUM's standpoint, but we are genuinely mid in the way in which we approach the portfolio. So we have so first of all, there are 5 factors at play. And I'm saying even within the 5th factor, which is size, we have mitigated that risk as well by genuinely being mid-cap and small cap and staying true to the profile of the product and the mandate of the product. And hence, I don't see size as a constraint because there are, like I said, many factors. And within size also, there are ways of handling that to some extent.
Now, with so much, Chirag, are you a 9 to 5 investor or a 9 to 9 investor?
I'm a 9 to 5. Well, 5 is a bit early, but I'm more of a 9 to 7 type investor in the sense that you know there's so much happening outside of work as well, which you want to focus on, right? There is you want to focus on yourself, you want to focus on health, you want to focus on family. I think it's very important to have a balanced existence, right? So I'm a father first, I'm husband next, and investor third, and so on. So I wouldn't rotate it the other way around. I wouldn't want it the other way around. So it's I leave work, and there is a lot of other fun activities to look forward to.
Got it. But the job also comes with its own competition, the stress, everything, etc. Right? And also being a listed company, HDFC AMC is one of the listed companies in India. Is there any pressure on performance from being a listed company?
I think there's pressure on performance in general. Right, this is a competitive industry, and our numbers are very, very visible. Right, you can see it daily, weekly, monthly, and so on. So it is going to be competitive, and there is that pressure. But I think the organization, part of the role of the organization is to diffuse that pressure to allow managers to make longer-term calls. Right, so if you get so caught up in monthly and quarterly performance, then you'll start making decisions which are based on monthly and quarterly outcomes. And you need to make decisions on yearly and decadal outcomes. And hence, the CEO's role in sales and marketing, etc., play a supportive role, right? We're not antagonistic in that fashion. And we are very appreciative to have an organization which is very forward-looking, a board which is very long-term in its orientation. And that all helps managers, gives them freedom and flexibility to take those calls. Otherwise, how will you be contrarian? How will you be value? How will you be different from others? So I think the pressure on performance is there, and that's, I think we get the question asked a lot, but it's true for every industry.
I think it's also the pressure from within, right? Mostly.
Yeah, ours is just, the data is just a lot more, right? Because you can really look at, difficult in a lot of other industries to look at weekly and monthly, and but here there's a lot more data.
Chirag, we talked a lot about the funds and then how its performance and the strategies. Are there any mistakes that you've learned from over the years?
Do you want them chronologically, alphabetically?
Maybe the top ones.
A couple of things that certainly I think everybody, it's not my learning, we've all learned from this, is the valuation spectrum bit, right? That don't always think that paying a cheap price is going to give you that degree of protection. That's not enough, right? Because if you buy a poor quality business at a throwaway price, you're still in as much trouble as you would owning a fantastic business at an obscene price. So I think that's I've certainly been caught in that trap many times. Oh, it's so cheap, and it becomes cheaper, or it just doesn't work because there are things that you didn't figure out about the management, things you didn't figure out about the company, and then there's been a lot of the mistakes at the other end of the valuation spectrum where things got a bit expensive and then you got out, and those went on to be 10x, 20x, 50x, just because it was 15-20% expensive, and you thought you could get cute and get back in later on and so on. Doesn't happen. You miss it, and sometimes you miss it for many, many years because that business just proves its worth and then never comes back to a valuation level which you're comfortable with. That's the beauty of this business. There is so much to be learned, and whether you're doing this for 20 years or 30 years or 10 years, you're all, somehow you feel that you're still fairly young in the business because there is so much to learn and so much to unlearn.
And it's dynamically changing every day.
All the time.
Yeah.
And the markets are fairly unforgiving.
That's all, Chirag. Maybe just last 3 questions. How do you invest your money?
So I have all my money in HDFC funds. We don't do stocks. We are by compliance mandate. So there's no stock investing. It's all mutual funds. I am largely, I'm 70% equity, all in HDFC equity funds across, most of it in my fund, but some of it in other fund manager products as well. And the balance 30-40% is 30% is in fixed income, again in HDFC mutual funds. That's it.
And what do you do outside work?
I have 2 young kids. They keep me busy, and like to spend time with the family. I think like everybody else.
Have you watched Mufasa?
I have not watched. My kids are not that young,
Oh.
so I'm not sure if Mufasa will cut it. But
Okay.
a lot of time with family, a little bit of travel, and so on. I've not done that yet. I think it's a big failing of mine. It's probably my biggest failure. And hopefully the last part of my career, not career, but post-career, will be a period when I can give back. I think that's very, very important. And I would like to hopefully give back, whether it's whatever might be to the environment, might be to people who need that help. But I would say certainly so far that's been not something that I've managed to do.
Thank you, Chirag. Thank you so much for joining us. I hope it's as informative and as interesting as I found it to the investors.
Thank you so much. I think it's been a very interesting experience, and we really appreciate the partnership with Zerodha. And thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.